Hi, I'm Barry Fennell. I'm an analyst here in the Lipper Research Group, and I was going to give an overview of how the flows fared during the quarter. So starting off on slide 31, just a high-level view of where the mutual fund flows and ETF flows went and didn't go in the first quarter. It certainly was a good quarter overall for mutual fund flows. We had a net of $105 billion coming into mutual funds. Overall, this was a good quarter for both equities and taxable fixed income relative to Q4 in particular. A lot of that was, as Tom and Jeff discussed, probably off the heels of strong performance in for the equity funds anyways. The strong performance we witnessed in 2013. A lot of fund investors looking to capitalize on some of that momentum. In the fixed income space, we saw about $35 billion come in. This was actually the first positive quarter for mutual fund flows in taxable fixed income since Q1 of last year. So we had 3 consecutive negative quarters in the taxable fixed income mutual fund space. Munis actually managed to post net positive flows, relatively modest, all in at $1.9 billion. But nonetheless, this was a positive development for the muni sector, as they had also witnessed 3 quarters previously of consecutive net outflows. Investors there being attracted back into the asset class for more attractive yields, and really no big new surprises on the muni bond front there as well, which was certainly helped to bolster the flows. Money markets had some pretty significant outflows, about $85 billion moving out of money markets. A lot of that going into taxable fixed income. Investors anticipating higher yields coming about, and after the volatility witnessed at the tail end of last year when QE was the winding back of the QE program by the Fed was unveiled, some of the plans for that, the tapering of the bond purchasing program. Once that initial news had passed, some investors felt comfortable about moving back into fixed income and taking advantage of the perceived higher yields that might be coming. Although with the volatility in the first quarter that we saw globally and even domestically with some of the weak economic news, that would also have contributed some of the flows into fixed income as well. ETF flows were relatively modest, but they were positive for the quarter in both equities and taxable fixed income. Kind of belies some of the volatility that we saw with the ETF flows, which tend to be significantly more volatile than the mutual fund flows, as most of them are coming from institutional investors. We saw some significant outflows, particularly in domestic equity ETFs, which I'll discuss in a moment in a little bit more detail, and in emerging markets as well. So moving ahead to slide 32, just sort of a breakdown of within equities where some of the fund flows went as far as mutual funds are concerned. All 3 categories, the broader categories, U.S. diversified equities, the sector funds, and world equity all saw positive net inflows for the quarter. Within U.S. diversified equities, saw a lot of continuing demand for long-short products, as investors are quite interested in limiting the amount of volatility that they have to experience within their portfolios. A lot of concern about the viability of the equity market rally that occurred in 2013 going forward. Also, this continuing long-term trend of funds flowing into passive products, funds that mirror S&P 500 index funds. The multi-cap core, large-cap core, mid-cap core areas all saw significant outflows. The strong performance last year of these products in 2013 also certainly helped to bolster the flows that came into those passive products. One interesting trend in U.S. diversified equity was how well value funds did in terms of net positive flows. Value certainly saw more flows on the positive side than growth. Large cap growth led the way actually in the category with negative outflows once again. In the sector area, in terms of sector funds, we saw biotech, healthcare lead the way. A lot of that was occurred earlier in the period, January, February time frame. Same with science technology funds, also saw positive net inflows here. Once again, most of those flows came prior to the mid-March when we saw a significant sell-off occur in those two areas. Global natural resources also saw some pretty significant outflows as well. World equity, as Tom touched on, had a great quarter in terms of net flows. Continues to attract assets. Some of the regions there are European funds. European region funds have had a very strong run in terms of net flows over the last several quarters, as have emerging markets have held up particularly well on the mutual fund side, as investors look for diversification and perhaps additional opportunities to step in and buy at cheaper relative valuations. We continue to see within world equity passive products doing well here as well. Funds in the international multi-cap core space, ETFs-type passive products, such as the Vanguard International Stock Fund, have done well in terms of flows, both this quarter and in the prior quarters as well. Skipping ahead to slide 33, just how some of the larger ETFs across different investment strategies fared in terms of flows during the quarter. SPY, the State Street product, the Spider 500, is the largest S&P 500 fund. Saw some, as we can see, the largest outflows amongst the ETFs. And the biggest outflows came in that product, as you can imagine, in late January, early February, as the emerging markets volatility roiled the domestic market here, and concerns about the strength of the economic domestic recovery also came to the forefront. But after the first week in February, after the week of February 5th, actually the product SPY only had 1 week of negative outflows, and that was relatively modest. So the bulk of those outflows came very early on in the period. EFA products hold up pretty well. That's EFA that's there. It had positive net flows, not unlike the index mutual funds that we discussed previously. That product continues to do well. QQQ, the NASDAQ product, the negative net flows there were actually less than one might anticipate, but they did see some pretty significant outflows towards the close of the quarter, when we saw that acceleration in technology stock shares sell off. EEM, the emerging markets equity ETF, as you can imagine, had pretty significant outflows pretty much throughout the whole period. Had weekly negative outflows. GLD, the State Street Gold ETF, did well for the quarter in terms of net flows relative to prior periods. Gold seemed to have found some price stability and a floor, and certainly the global market volatility helped to dampen the outflows for the product. DVY, kind of interesting there. That's the select dividend ETF. That had modest net outflows, but the category as a whole, which I'll discuss a little bit further, the equity income category, has had a somewhat surprising last period of net outflows in January, February, and March. This is just relative to how it had fared in the last several quarters. Positive flows were seen in EWJ, which is the iShares MSCI Japan ETF. Japan obviously had a phenomenal year last year. There's also some hope that performance will continue, as Japan seems to want to keep its yen relatively cheap relative to the dollar, which would certainly help to bolster the outlook for a lot of its economy, as it's export driven. Skipping ahead to slide 34, just how some of the equity flows fared in terms of the classifications. Within U.S. diversified equity, as we sort of touched upon, multi-cap core did well. It took in about $7.5 billion during the period. Some of the big gainers were the passive products, the Fidelity Spartan Total Market Index Fund and the Vanguard Total Stock Market Index Fund were big gainers there. In long-short equity, it continues to do well in terms of gathering flows. And some of the funds there, the Neuberger Berman Long-Short Fund did well, as did the Mainstay Market Field Fund in terms of net flows. Sector equity, once again, most of that was earlier in the period. In terms of biotech, the Fidelity Select Healthcare Fund, T. Rowe Health Sciences, all did relatively well in terms of flows. World equity, once again, it's a passive product there that really seemed to be continuing with some of the traction they had there. Multi-cap core products there, Oakmark International has continued to do well off the heels of some pretty strong performance. DFA International Core Equity, Vanguard Total International Stock Index also took in some significant flows there as well. The losers in terms of U.S. diversified equity would be the equity income products had net outflows of about $1.8 billion. No category had tremendous net outflows, as was such a positive quarter overall for equities in general. But some of the larger funds there are Fidelity Series Equity Income, Vanguard Dividend Growth, losing some assets there in terms of net outflows. In terms of sectors, commodities continues to be in redemption mode, and some of the natural resources funds continue to lose assets. Losers of note in the worldwide equity space in terms of classifications would be Pacific ex-Japan, a lot of the emerging countries around Asia being their economies being put in a more volatile state with the winding down of QE and some currency fluctuations. And China region funds have been hurt as well by some mixed economic data, manufacturing data in particular coming out of China earlier on in the period. Pacific region funds in general have seen some modest net outflows as well. Moving ahead to slide 35, just taking a step back and seeing how classifications did from an overall perspective. The top gainers in terms of fund flows, as we've discussed, international multi-cap core continues to be a favorite of investors. Alternative credit focus is also known as unconstrained bond funds, continues to grow in popularity. It's a category that we have been taking a closer look at recently as more fund companies have launched products in this area. Neuberger, for instance, has launched one recently there. The traction there, the thesis there is that you need more of a go-anywhere mandate in this type of low-yield environment in order to achieve better total returns in the fixed income space, give the manager an ability to allocate across asset classes and not be constrained to a particular index. That's getting broader appeal as yields in the fixed income space have remained low for quite some time now. Multi-cap core, passive products there, once again, have continued to do well. Loan participation funds, loan space continues. Floating rate income funds have continued to see significant positive net inflows as the fears of rising rates are still in the back of the minds of many investors, and overall yield environment is quite challenging for those looking for income. And additionally, with that asset class, it allows many investors to stay short duration, which is quite appealing if you think that rates are going to rise sooner rather than later. long-short equity products continue to attract investors who are concerned about market volatility. The bottom classifications, money markets, investors looking to put some money to work, particularly after the strong equity market rally of 2013 and the anticipated rise in rates on the long end of the curve has certainly got investors thinking about how to achieve more yield and ultimately more income. Slide 36, just how we did in terms of net flows across the taxable bond fixed income space. As we touched upon, new products in the alternative credit focused space, unconstrained bonds, have continued to attract assets, loan funds, folks still looking to stay short duration with their portfolios. High yield continues to attract assets. The appeal of the yield is the obvious reason. Also, with the economy on better footing, the prospects for the asset class are more improved in many investors' minds than they were, say, 6-9 months ago. As you look down the slide there, you can see that most of the products that continue to take in assets in the taxable fixed income space are all of the short duration, short maturity nature. And on the opposite end of the spectrum, in terms of net outflows, longer duration, longer maturity products, core plus bonds, intermediate bonds, all seeing net outflows. TIPS continue to see outflows. There was a blip there during the quarter where they did take actually in positive flows for the first time in a while for a 2-week period, but still investors' inflation expectations are still pretty diminished. So the asset class continues to see outflows. Emerging market debt, obviously, hard currency and local currency both saw some outflows as investors are concerned about the volatility there. Moving ahead to slide 37, just some of the interesting trends in terms of flows that would be interesting to keep an eye on in the upcoming weeks and months in terms of classifications. Equity income, which is the red bar, had positive net inflows for every month throughout 13 and for several months before that as well. And this quarter, it's seen 3 consecutive months of outflows. Perhaps it's investors who would use it as a bond yield-like alternative for those looking for income. And now with the expectation of higher rates coming, finally coming, some investors may be looking to take advantage of that by moving back into taxable fixed income. Presumably that would give them a greater degree of security and also a higher level of income as well, although that has not come to pass this quarter due to the global market volatility and the political tensions that we've seen in Eastern Europe. It's interesting to note that the 10-year Treasury actually was at 3.04% on January 1, and it was at 2.80 on April 3rd. So yields have actually come down in the quarter, which is relatively unexpected. In the loan participation category, I highlighted that with the blue bars there in terms of the mutual fund flows, as I'm sure you're aware, have been positive for several quarters in a row. That number, but it does seem as if at this point, if rates did begin to rise and the talk of the short end of the curve perhaps going up quicker than anticipated, is something to keep an eye on if the flows here continue, or if perhaps they go the other way as the asset class has grown so dramatically over the last 5 years. It would be interesting to see how the asset class holds up if it went into a redemption type mode. And the yellow bars, just as we discussed earlier, the appeal and the attraction to fund investors of alternative credit focus, unconstrained bond funds have continued to attract assets over the last several months as new products are rolled out, and the appeal is being put forth by advisors and marketers to folks such as retirees as to what they could potentially offer in terms of total return by being able to invest across asset classes. Well, that's all I had in terms of fund flows. So with that, I hand it back to Tom.